friends, thank you for being here today. What if I told you that the widely broadcast narrative of a great wealth transfer promised era where trillions of dollars will naturally and equitably flow on the older generation to the younger is actually a mathematically impossible myth designed to keep you complacent while your financial future is dismantled? And does it not chill you to consider that the economic machinery currently in motion is not designed to distribute wealth, but to siphon the remaining purchasing power of the middle class into the hands of a select few? To understand the economic reality of the United States in the 21st century, one must look past the headlines and into the engine room of the economy. We are constantly told that we are on the precipice of a golden age for heirs. The media, financial planners, and pundits repeat a dazzling statistic: $124 trillion. According to major analytical firms, this is the exact amount of wealth set to change hands in America by 2048. It is painted as a tidal wave of prosperity that will rescue millennials and Gen Z from the struggles of student debt and housing unaffordability. However, if you look closely at the mechanics of our monetary system, the history of tax policy, the degradation of pension security, and the behavior of precious metals, a darker picture emerges. The media calls it a transfer. History calls it a consolidation. We are witnessing a mathematical inevitability playing out in front of our eyes. If you believe you are on the receiving end of this transfer simply because you are young or because you have worked hard, you need to understand something critical. You are not watching wealth move. You are watching it concentrate. To truly understand the nature of this event, we must first define it not as a distribution, but as a consolidation. To diagnose the problem, we must first dismantle the lie of the great handover. The figure of $124 trillion is dangled before the American public like a carrot, creating a sense of inevitable salvation. But averages in economics are dangerous illusions. When you drown in a river with an average depth of 4 feet, the average does not save you. The specific depth at your location kills you. Similarly, the aggregate wealth of the United States is technically at an all-time high, standing at roughly $163 trillion, inflated by surging stock valuations and real estate bubbles. But who holds this wealth? As of 2024, the top 1% of American households hold 30.8% of all wealth, equating to nearly $50 trillion. Conversely, the bottom 50% of the country, half the population, holds a meager 2.8%. When analysts predict a $124 trillion transfer, they often fail to highlight that $62 trillion of that sum originates from the wealthiest 2% of households alone. This money is not going to flow into the general economy or into the hands of the average struggling family. It is going to flow from the top 1% of the older generation to the top 1% of the younger generation, likely locked inside trusts, family foundations, and tax-advantaged vehicles that ensure it never touches the hands of the working class. For the vast majority of Americans, the wealth transfer is a ghost story. Northwestern Mutual's 2024 study reveals a stark expectation gap. While millennials and Gen Z expect to inherit trillions, only 26% of Americans actually plan to leave an inheritance. Only 22% of boomers and Gen Xers believe they will have anything left to give. The median inheritance for the bottom 90% of Americans is statistically close to zero. Therefore, the event we are witnessing is not a distribution, it is a consolidation. The wealth of the middle class is being eroded by inflation and debt, while the wealth of the asset-holding class is being inflated by monetary expansion. This is not an accident. It is the logical conclusion of a 4-stage economic pattern that has destroyed the middle class. of every major civilization that has ever existed. I want to pause here for a moment because this is a hard reality to accept. Do you see this consolidation happening in your own community? Or do you still believe the promise of a future windfall is real? Leave a comment below with your thoughts. I really want to know if what you are seeing matches the data we are discussing. This consolidation is not unique to modern America, but is the inevitable result of a four-stage historical pattern of currency collapse. This consolidation is not unique to modern America. It is a recurring historical phenomenon, a four-stage pattern so predictable that once you see it, you can watch it unfold in real time, from the Roman Empire to the Weimar Republic. The death of a currency always facilitates the transfer of wealth from the many to the few. Stage 1. The foundation. Every great civilization begins with a currency backed by something real. In Rome, it was the silver denarius. In the United States, under the Bretton Woods system established in 1944, it was the dollar pegged to gold at $35 an ounce. This connection to physical reality creates trust. It imposes discipline on the government. They cannot spend what they do not have. This fosters genuine economic expansion and the growth of a robust middle class, creating the illusion that the good times will last forever. Stage 2. Expansion and debasement. Inevitably, governments become ambitious. They face mounting costs from wars, welfare programs, and imperial overreach. In Rome, it was the cost of maintaining legions and the bread and circuses for the masses. In the United States, it was the combination of the Vietnam War and the Great Society programs of the 1960s. When tax revenue is insufficient, desperate governments do what they always do. They quietly degrade the currency. Nero reduced the silver content of the denarius from 95% to 80%. This is the beginning of the theft. It is subtle at first. The coins look the same, just as our paper dollars look the same, but their purchasing power is being hollowed out. In the US, this stage culminated on August 15, 1971, when President Richard Nixon suspended the convertibility of the dollar into gold. This was the Nixon shock. The tether to reality was cut, and the dollar became a pure fiat currency, backed only by government decree. Stage 3. Loss of control. We are currently living in stage 3. In this stage, the government, freed from the discipline of gold, prints money to solve every problem. The currency supply expands exponentially. In Rome, by 253 AD, the silver content of the currency had dropped to 20%, and eventually to just 2% in Weimar Germany. The government printed marks to pay striking workers and war reparations, leading to an exchange rate of 4.2 trillion marks to the dollar by 1923. The defining characteristic of Stage 3 is inflation, not just the rising price of milk and eggs, but asset price inflation. The middle class, who have been taught to save in currency cash, savings accounts, bonds, get obliterated. Their savings are static, but the cost of life skyrockets. Meanwhile, those closest to the source of money creation, the Cantillon effect, survive and thrive. The elites, the landowners, and the politically connected borrow money cheaply to buy assets. As the currency collapses, the nominal value of their assets explodes. They effectively short the currency and go long on. Reality. Stage 4. The reset. The final stage is the reset. The currency is destroyed or replaced. In Germany, it was the introduction of the Rentenmark. In Rome, the empire fractured. In this phase, wealth has finished transferring. The millions who held paper are destitute. The thousands who held gold, land, and productive assets own everything. The system restarts, but the previous middle class is gone. America is accelerating through Stage 3. Since 1971, The Federal Reserve has expanded the money supply exponentially. The national debt exceeds $36 trillion. Real wages for the working class have stagnated for decades, while the top 1% now controls wealth, equivalent to the bottom 90% combined. The machine was built centuries ago, and it is operating exactly as designed. The engine of this modern transfer is driven by a sovereign debt crisis that has trapped the government in a spiral of deficits and inflation. The engine of this modern transfer is the United States sovereign debt crisis. The financial health of the nation is deteriorating at a pace that suggests we are nearing the end of the current monetary cycle. The United States now spends more on servicing the interest on its debt than it does on its entire national defense budget. Think about the implications of that fact. Trillions of dollars in tax revenue are collected from the working population not to pay for roads, schools, or defense, but to pay interest to bondholders. Who are these bondholders? They are central banks, sovereign wealth funds, and wealthy institutional investors. This is a direct wealth transfer mechanism. Taxes are extracted from the labor of the middle class and transferred immediately to the asset-holding class in the form of interest payments. The government is trapped in a debt spiral with no painless exit. Economists and the Congressional Budget Office project that the debt-to-GDP ratio will continue to climb. There are only 4 ways out of this trap, and 3 of them are politically impossible. First, there is austerity. The government could slash spending to balance the budget, but with an aging population dependent on Social Security and Medicare, and a military-industrial complex addicted to defense spending, deep cuts are politically suicidal. Furthermore, the U.S. economy has become addicted to the stimulus of a $2 trillion annual deficit. Removing it would cause an immediate, catastrophic depression. Second, there is taxation. The government could raise taxes significantly. However, history shows that raising taxes beyond a certain point stifles economic growth and often yields diminishing returns. Moreover, the wealthy have the means to move capital and avoid taxation, meaning the burden would fall on the upper middle class, crushing them further. Third, there is default. The U.S. could simply refuse to pay its debts. This would destroy the global financial system overnight, as U.S. treasuries are the collateral for the world's banking system. This leaves the fourth and most likely scenario: inflation. The government will choose to print away the debt. By expanding the money supply, they make the dollars they owe less valuable. They pay back their creditors with devalued currency. This is a soft default. It saves the government, but it destroys the saver. It is the mechanism by which the wealth of the responsible saver is transferred to the profligate government and the asset-rich speculator. This is why the wealth transfer is inevitable. It is the government's only survival strategy. While monetary policy degrades your savings, the tax code has been structurally engineered to act as a tool for the elite. While monetary policy degrades the value of your savings, fiscal policy, specifically taxation, has been engineered to accelerate the concentration of wealth. To understand this, we must look back to the origins of supply-side economics, often summarized by the famous Laffer curve in 1974. Economists like Arthur Laffer and politicians like Dick Cheney and Donald Rumsfeld popularized the idea that cutting taxes on corporations and the wealthy would spur investment, create jobs, and ultimately increase tax revenue through growth. This trickle-down theory became the bedrock of American economic policy, starting with the Reagan administration in the 1980s. The narrative was seductive. If you let the job creators keep more of their money, they will build factories and hire workers. But the data from the last 40 years tells a different story. The tax cuts of 1981 and more recently the Tax Cuts and Jobs Act of 2017, did not result in a boom for the working class. The 2017 Act cut the corporate tax rate from 35% to 21%. Proponents claimed this would lead to a $4,000 to $9,000 raise for the average family. It did not happen. Analysis reveals that the vast majority of these corporate tax savings were not used for research and development or for increasing worker wages. Instead, they were funneled into stock buybacks. A stock buyback is when a company uses its cash to purchase its own shares on the open market. This reduces the number of shares available, which artificially inflates the price of the remaining shares. This directly benefits shareholders and executives whose compensation is tied to stock performance. Since the top 10% of households own 85% of the stock market, corporate tax cuts are essentially a direct cash transfer from the public treasury to the private portfolios of the wealthy. Furthermore, the tax code is riddled with loopholes that allow the ultra-wealthy to opt out of the system that binds the middle class. While a teacher or a firefighter pays taxes on every dollar they earn before they even see their paycheck, billion-dollar corporations often pay effective tax rates of nearly zero. Studies of major corporations like Verizon, Walmart, and AT&T have shown periods where these entities paid single-digit effective tax rates, or even received refunds, despite billions in profits. In some cases, the CEO's compensation package exceeded the company's entire federal tax bill. This system creates a compounding advantage. The wealthy pay a lower percentage of their income in taxes, allowing them to reinvest more capital, which generates more wealth, which is taxed at preferential capital gains rates, which are lower than income tax rates. Meanwhile, the middle class bears the brunt of the tax burden, while their wages stagnate. This is not a free market. It is a rigged game where the rules are written by the winners to ensure they keep winning. Perhaps the most cruel aspect of this mechanism is the systematic dismantling of retirement security, shifting the burden from employers to individuals. Perhaps the most cruel aspect of this wealth transfer is the dismantling of retirement security. There was a time when the American worker could rely on a three-legged stool of retirement, social security, personal savings, and a defined benefit pension. A defined benefit pension was a promise. If you worked for a company for 30 years, they guaranteed you a monthly check for life. The risk of the market was borne by the employer. If the stock market crashed, the company still had to pay you. This changed with the passage of the Employee Retirement Income Security Act of 1974. While the act was ostensibly designed to protect workers, it paved the way for the 401k and the shift to defined contribution plans. This shift was profound. It transferred the risk of retirement from the employer to the employee. Suddenly, a factory worker or a school teacher was expected to be their own hedge fund manager. We are now witnessing the first full generation of workers, the baby boomers, retiring under this experimental system. And the results are catastrophic. The promise of the 401k was that compound interest would make everyone rich. The reality is that most Americans have nowhere near enough saved. Worse, those who do have pensions are discovering that the funds are empty. Public pension funds across the country are severely underfunded. Mismanagement and corruption have plagued massive funds like CalPERS, California Public Employees Retirement System. Forensic investigations have revealed that these funds often chased high returns in risky, high-fee investments to cover up their shortfalls. They moved in herds, buying into bubbles just before they burst. Now, retirees face a double threat. On one side, their savings are insufficient. On the other, the currency in which those savings are denominated is being debased. A retiree with a fixed income of $3,000 a month is helpless when the cost of living rises by 20% over a few years. Financial planners often advise boomers to stay in the stock market to chase yield, exposing 70-year-olds to the risks of a market crash. In 2024, the stock market is trading at historically high valuations, detached from the reality of the struggling economy. If a correction occurs similar to 2000 or 2008, millions of retirees could see their nest eggs evaporate overnight. But this time, they do not have the time to wait for a recovery. This creates a desperate class of elderly citizens who are forced to sell their assets, homes, heirlooms to survive, further feeding the consolidation of wealth by those with the cash to buy them out at fire sale. Prices. We can see the cracks in the system clearly if we look at the market signals, specifically the divergence between equities and gold. How do we know the system is breaking? We look at the signals the market is sending, specifically the relationship between the stock market and gold. Traditionally, investors held U.S. Treasury bonds as a risk-free asset to balance their portfolios. The assumption was that the U.S. government would always pay its debts and the dollar would remain stable. However, as the debt-to-GDP ratio spirals out of control, trust in this assumption is fracturing. We are seeing a historic divergence. Gold prices are hitting record highs, even as official inflation numbers claim to be cooling. Why? Because gold is no longer just rising as a hedge against the price of bread. It is rising as a hedge against the solvency of the United States government. Smart money is fleeing treasuries. Central banks around the world, particularly in the East, are dumping dollars and buying gold at record paces. They see what is happening. The U.S. has no choice but to devalue. Historically, the ratio of the stock market to gold is a powerful predictor of wealth transfers. During times of stability, stocks outperform gold. But during times of systemic crisis, the Great Depression, the stagflation of the 1970s, the dot-com bust, the stock market plunges when measured in gold. We are currently seeing the beginning of a massive rotation. The stock market, propped up by printed money and hype, is precarious. Gold, the only asset that is no one else's liability, is asserting itself as the true store of value. This signal tells us that the wealth transfer will not be a transfer of cash, but a transfer of value from paper assets to real assets. Those holding paper stocks, bonds, cash will see their purchasing power transferred to those holding real things: gold, silver, commodities, land, beyond traditional assets. The elite are accelerating this consolidation through the weaponization of debt and the adoption of absolute digital scarcity. While gold remains the historical bedrock of preservation, we must acknowledge that in the 21st century, the mechanics of the heist have evolved, and so to have the tools of the elite. To fully grasp why this wealth gap is widening at an exponential speed, we must look at a concept the futurist Buckminster Fuller called the grunt, the gross universal cash heist. This describes the hidden mechanism by which the banking system, through inflation and complex financial instruments, systematically harvests the productivity of the working class. But the wealthy do not just survive the crunch. They weaponize it using a specific tool: debt. The average American is taught that debt is evil. This is because, for the consumer, it is. Credit card debt at 25% interest used to buy depreciating consumer goods is a shackle. But the elite operate by a different set of rules. They understand that in a high inflation, fiat money regime, productive debt is an asset. This is the strategy of arbitrage. If the real rate of monetary inflation is 15%, meaning the currency is losing 15% of its value annually, and you can borrow money at a fixed rate of 6% to buy a scarce asset that appreciates at 15%. or more, you are effectively being paid to borrow money. You are shorting the dollar. Consider the strategy employed by modern corporate treasuries and billionaires. They do not hoard cash. Cash is a melting ice cube. Instead, they utilize public debt markets to borrow billions of dollars to acquire hard assets or even to buy back their own stock. This is a form of leverage that the average saver cannot access, while the saver works for dollars. The investor puts the dollar to work. The investor borrows the currency that is being printed into oblivion to acquire the assets that cannot be printed. When the debt comes due years later, they pay it back with devalued. Cheaper dollars, the difference, the arbitrage, is wealth transferred directly from the saver whose purchasing power was diluted to the debtor who acquired the asset. This is the secret engine of the consolidation. The destruction of the currency effectively subsidizes the acquisitions of the borrower. Furthermore, a new asset class has emerged that acts as a cheat code in this environment: digital scarcity. Specifically Bitcoin. Well, gold has served as a hedge for 5,000 years. It has physical limitations. It is heavy, costly to transport, and its supply increases as mining technology improves. Bitcoin, however, represents the first time in human history that we have an asset with a strictly capped supply that is mathematically immutable. There will never be more than 21 million. In a world of infinite fiat printing, absolute scarcity becomes the ultimate safe haven. We are seeing a generational shift where institutional capital is beginning to recognize this pristine collateral, just as the grunt steals wealth via inflation. Decentralized digital assets offer a technological shield against that theft. They exist outside the traditional banking system, immune to the debasement policies of central banks. The wealth transfer is not just about old money moving to young people. It is about value fleeing from the soft money of government fiat into the hard money of digital commodity. Those who understand this shift are positioning themselves to capture the upside of the currency collapse, while those who cling to traditional savings accounts are left holding the bag of a dying currency. This is not speculation. It is a flight to safety in a digital age, further separating those who understand the new rules of money from those playing by the old ones. Ultimately, we must confront the reality that this machine operates without empathy, leaving you with a critical choice for your financial survival. The 120 for $1 trillion wealth transfer is not a lottery ticket waiting to be cashed by the youth of America. It is a siphon. It is the endgame of a monetary cycle that prioritizes the survival of the state and the asset-holding elite over the prosperity of the working class. The machine that drives this, the combination of fiat currency debasement, a debt-based economy, a rigged tax code, and the financialization of retirement, operates without malice, but also without mercy. It is simply mathematics. When you debase a currency, you destroy the savers and reward the debtors. When you tax labor higher than capital, you destroy the workers and reward the investors. When you transfer risk from institutions to individuals, you destroy security and create anxiety. So, where does this leave you? It leaves you with a choice. You can continue to believe the narrative that a windfall is coming, that the government will solve the debt crisis without inflation, and that your 401k is safe. Or you can look at the pattern of history. The winners of this transfer will be those who own assets that cannot be printed. They are the ones who hold gold, silver, productive real estate, and perhaps decentralized digital assets like Bitcoin that exist outside the banking system. They are the ones who understand that in a period of currency collapse, having no debt and holding real value is the only arc that floats. The losers will be the majority. They will be the ones holding cash in savings accounts, believing it is safe while it rots from the inside out. They will be the ones waiting for an inheritance that has already been consumed by end-of-life care costs and inflation. The machine was built centuries ago. It destroyed the middle class in Rome. It destroyed the middle class in Weimar Germany. And it is dismantling the middle class in America today. If you are finding value in this analysis and want to stay ahead of these economic shifts, please take a second to like this video and subscribe to the channel. It helps us get this crucial information to more people. The greatest wealth transfer in history has indeed begun. But unless you position yourself on the right side of the transaction, you are not the recipient, you are the source.